You played violin for 6 years and you're part of the women's board of the Chicago Symphony. I'd love to learn a little bit more about that.
Yeah, I've long loved classical music. Growing up in Oklahoma City, we did have a symphony orchestra, and my dad would take me. I started playing violin in middle school, and I was always first or second chair violin, but I knew that it didn't come easy. And I have a daughter now who's a teenager, and she plays violin and she plays cello, and her ability to read music and memorize music is a lot more natural than for me. So I think that it gives me an appreciation for professional musicians. Not only are they talented, but the amount of practice and the years of investment that they've made into their careers, it's just remarkable. And so I was able to join the women's board and involved with fundraising there, and I serve as the secretary of that board. And it's, a great group of women who are very passionate about classical music and frankly trying to introduce classical music to a much broader group of citizens in Chicago. And there's a lot of outreach that the CSO does for, school age children, just trying to create that similar love of music.
That's awesome. That's really cool. My dad actually plays cello too, so I kind of grew up with. He's actually a nuclear engineer, so the kind of the math brain and then the music actually translates pretty well, I think.
It does. It's like learning a new language, and I think cello is such a beautiful instrument. I never played, but it has such a rich sound. And my daughter's only a year into taking cello, but she plans to play for her high school orchestra, which is pretty awesome. As a mom, to see her go on and do that.
Very cool. Let's dig more into kind of your background and talk about kind of equity investments, how you got into this space, and kind of where we're at today. That'd be a great kind of starting point too.
Sure. So XA Investments, the A in XA Investments stands for alternatives, and that's what we're focused on here. We're part of a larger investment bank in Chicago called XMS Capital Partners, and I helped found the asset management business 8 years ago, leaving Nuveen Investment where I spent 12 years, and I headed up product development for their global structured products business, which was largely listed closed-end funds, UITs, commodity pools. And because of my work with commodities and currencies, which are more liquid alternatives because they're futures based, that for me really drove an interest in exploring more private market, alternatives. And the business here, we have a research and consulting business where we help alternative asset managers, we help GPs build registered funds that are suitable and appropriate for individual investors. And we also have a proprietary fund platform of our own. We have a listed closed end fund and we have an interval fund. And so we're able to give our clients the advice that they need, but it's from a practical standpoint, having implemented and built out a platform of our own here at XA Investments.
Absolutely. Yeah. Thank you. You mentioned the research aspect. So talk to us about kind of the work that you guys do with some of the funds that you guys work with.
Sure. Our research covers the entire interval and tender offer fund marketplace, it's just a registered structure. It shares some similarities with registered mutual funds, but also with listed closed-end funds. And that marketplace is really a mix of different alternative investment strategies, including private credit, private real estate, infrastructure, long short equity, hedge fund strategies, you name it. If it's an alternative investment strategy, it would fit into an interval fund. And that marketplace is really growing in terms of financial advisor adoption of interval funds because it allows financial advisors to provide clients with alternative investment exposure that they otherwise wouldn't have access to if you were simply investing in stocks, bonds, mutual funds, and ETFs. So it opens up a much larger array of potential return and yield options to the extent that you can access strategies that are less liquid or even illiquid for a small part of an investor's portfolio. It may be appropriate to add an allocation to alternatives. And, we all experienced 2022 where stocks, bonds, nothing was really working. And I think it's really been in the last 2 years that both investors and financial advisors are thinking long and hard about their asset allocation mix, and alternatives are really being used as substitutes for what would otherwise have been, a 60/40 stock bond allocation, because alternative investments can deliver on both the income goals that investors have who are, maybe in retirement and relying upon their investments for income, but they can also achieve some of the total return objectives that you might otherwise be allocated to, like large cap growth equities, which a lot of Americans are tend to be over allocated and maybe overexposed.
That makes a lot of sense. And maybe for our audience, maybe you can define what an interval fund is as well, and why someone would use an interval fund versus another fund wrapper.
Sure. An interval fund is a semi-liquid. It's technically a non-listed closed-end fund, which means that investors get in and out of the fund at net asset value. Typically, investors who would buy a registered interval fund would many of the funds are daily net asset value. Some are not. Some are monthly net asset value. I mentioned that because it also you're going to want to get in at a current NAV. So if it's a daily NAV, you can enter the fund on a daily basis. If it's monthly, typically there'd be a monthly in. Now, interval references this liquidity window that investors have access to. We typically recommend that investors thinking about allocating to private markets, that they have a medium to long-term investment horizon, so 3, 5, 7 years. But nonetheless, you may be thinking, well, when I do want to exit, how do I do that? And when do I do that? So interval speaks to the liquidity window. Typically, most interval funds allow quarterly exits. Now, if everyone wants to exit at the same quarter end, there'll be a queue, and shareholders would be subject to proration, which means they'd get a portion of the liquidity that they requested. So this is a risk. This is sort of a known feature, and it's a good fit for less liquid or illiquid investments, things that are long duration like infrastructure or real estate, because the portfolio manager can provide and plan ahead for a limited amount of liquidity, and it does protect investors overall who are staying in the fund, such that you're not having to sell more than the allotted amount, which once again is typically about 5% of the portfolio is offered up for liquidity for investors. So, we encourage people to think about, if they need liquidity, think about other sources of liquidity in your entire investment portfolio, things like cash or mutual funds or even ETFs, which are going to be a lot easier to get in and out of. Now, interval funds are typically, I think, going to be reserved for the portion of your portfolio where you might have a multi-year hold in mind.
That makes sense. And these are for uh, retail investors, credit qualified investors. I guess the term retail alternatives is a kind of thing who you talk to, what that means for people.
Yes, depending on the strategy, suitability is going to vary a little bit. I'll speak to private credit, which is the largest part of the interval fund market. There's now 70 private credit funds, different strategies. You've got the market leader Cliffwater with direct lending. You have a number of different structured credit. You have some asset-backed, income-oriented funds. So a nice variety of private credit strategies. Most of those private credit strategies are sold without any suitability restrictions. To the extent that the fund is like a fund of funds, we often see fund of private funds in the PE category in terms of private equity, or even in the real estate category. But some of the fund of funds, you'll see a suitability restriction at the accredited investor level. To the extent that you've got an alternative investment manager that charges performance fees in their private funds, and they launch an interval fund or tender fund, some of those institutional managers will also want to charge a performance fee. So Hamilton Lane is a good example. They do charge a performance fee at the fund level, at the registered fund level, and so that therefore suitability is limited to qualified clients. And I think that the reason financial advisors tend to like interval funds is that most fund sponsors are trying to create a product for the broadest possible audience. There's a handful of funds that have this sort of higher suitability at the qualified client level, And you're typically seeing those types of products sold more so into the wirehouse platforms, where there's a large buyer base. But the typical interval fund is sold more into the RIA or the family office channel, and that's being done typically with no suitability restrictions. Every now and then you'll see an accredited investor. Sometimes suitability is imposed by the firm marketing the product, or by the brokerage firm themselves, because they have a view on what's appropriate for their clients. And a lot of gatekeepers and brokerage firms feel like alternatives should potentially have higher suitability restrictions just because of the education component that's involved.
Yeah, thank you for going into that for us. How about compared to, typical like private fund? Because it sounds like, because you mentioned, you don't need to be an accredited investor. I mean, it sounds like it'd be incredibly beneficial for like a fund manager to, maybe launch an interval fund instead of a private credit fund. With are there like restrictions to the amount of investors that could, be in one of these interval funds?
I think you just pointed out that one of the main reasons why a fund sponsor would launch an interval fund is that you don't have any quantity limitations on who can go into the fund. And so that allows them to, right there, be able to market the fund more broadly, and to have, I would say that the main goal for fund sponsors is, they're diversifying their revenue base because they're able to introduce their investment strategy to people who would otherwise not be buying a private fund. Or maybe they like private funds from a financial advisor's perspective. There's a lot of, you'll obviously put your ultra high net worth investors into private funds if that's what they wish to do, but you're going to have K1s, tax forms that need to get processed. You're also typically going to have subscription documents that those clients would need to sign to enter into a private fund. And so a lot of the benefits from interval funds, particularly on the front end, if you don't have any suitability restrictions, the daily NAV interval funds can be purchased electronically in the same way that mutual funds can be purchased. And you're not going to be getting a K1, you're going to get a 1099. And furthermore, just as an SEC registered product, you've got the protections of the 1940 Act for shareholders. You also have an independent fund board who has oversight of the managers and are there to protect shareholders, and represent shareholders' best interests. So those are some of the benefits of being in a registered interval fund structure, contrasted with just a private fund.
It sounds like obviously cost is a little more expensive, but you can, the portfolio could be more concentrated given you have more leeway there in an interval fund versus a straight 40 Act mutual fund.
Yes. Yeah. The 40 Act mutual funds, they have a limitation where you can't put more than 15% of the portfolio into securities that, can't be liquidated in 7 days or less. And so, as you think about private credit, there's a whole world of investment opportunities that don't fit that definition. And so the interval fund space really opens that up, just even in the asset backed market or the direct lending market, where there's a lot of growth, just as banks have stepped away from providing loans to businesses and to individuals. The direct lending firms have stepped in to fill that gap. But direct lending is not a strategy you're going to find available in a mutual fund or an ETF wrapper. There's a lot of press on this, but it's worth repeating, which is that in the US, companies are staying private longer, and we hear a lot about these unicorns, that are late stage private equity. But Americans are missing out on an opportunity to participate in that growth, earlier stage growth of American companies. And so the only way to participate is to have an investment in venture capital or in private equity. These companies used to go public and they'd be small cap, companies. And now when the unicorns go public, they're mid to large cap size firms. So that's a large, that's just represents a shift in the last 25 years in terms of the capital markets. And so now the investment product arena is sort of catching up to that. And so we don't want individual investors missing out on that growth that's happening. not, like we were talking about, direct lending is happening now because banks have stepped away from lending. On the equity side, companies are staying private longer. So, uh, you need some of this access to be able to replicate, returns that, if we go back and look at historical long-term returns, this is something that endowments and pension funds have long known, and they've had very high allocations just given their long-term investment horizons to things like real estate and infrastructure and private equity. And so now there's an opportunity for a larger group of investors and individual investors to find opportunities that they're interested in.
As you were talking about this, I was thinking about the distribution aspect. Um, when somebody creates an interval fund, can I have a TD Ameritrade account? Can I purchase these, or does it need to go through an advisor? And I guess when it comes to the other side of that distribution, are you guys kind of like hosting these, or can you kind of get into that aspect?
Sure. They're largely the interval fund marketplace right now is focused on financial advisor, basically purchases. And so there are some opportunities for what I would call more direct to consumer platforms. A few examples would be like Yield Street or Fundrise or SoFi. SoFi just onboarded, I believe, 8 interval and tender offer funds, and I think that, eventually we'll see the likes of Fidelity and TD, those types of platforms open up to allowing investors to go into at least the interval funds with no suitability restrictions. I think that we'll see that in the future. We're not there yet. Fidelity, though, is launching or has launched their own proprietary interval funds with the Fidelity brand and with Fidelity portfolio managers. So presumably they'll be opening up access to other fund sponsors' products as well. I'm a Fidelity customer, and I've long asked them to have, there's not much in the way of alternative investment options. You have things like AQR, more liquid alternative strategies, but I think that we're going to see a lot more access in the years to come. What I would say that there's two things slowing that, which is there is technology investment that's going to be needed at the clearing and custody firms and at some of these platforms. So that's why the SoFis of the world have stepped in to create sort of um, a platform where you can get access without having a financial advisor. But when we talk about interval fund uh, providing liquidity, it's still a manual process for the clearing and custody firm. So that right there is going to slow down the onboarding of new products it already has. I mentioned there's 220 funds in the market today. Most of them have been launched in the last 5 years, but there's 42 new funds in the SEC registration process today. So but it's going to be those funds will take a while to get up and running just because the technology and the pipes are not really built for these products the way our industry has sort of built automation in to handle mutual funds or to handle ETFs. So that level of investment is still yet to come.
Yeah, that makes a lot of sense. For the demand, like what types of strategy? You mentioned private credit is a big component. What other strategies are trending upward in the interval fund space?
Yes, the two categories that saw the most net flows in 2023 were private credit and then private equity. A number of the private equity funds kind of hit their stride, meaning they had been launched several years ago. Private equity is a little slower out of the gate. You have the invest up that can take longer. You have positions that will sit at historical cost for a period of time. You have the J curve. And so that's why a private equity fund, firms or advisors may be saying, well, I'm going to wait and see what it looks like at the 3 year point. So it needs a little time to percolate. But many of those funds were launched, and they have a sufficient track record now for people to allocate. We've also seen an acceleration of net flows into interval funds as more of these products have been onboarded in Morgan Stanley, Merrill Lynch, UBS, and Wells Fargo. So that accelerates sort of because those gatekeepers will wait till a fund has a certain size and a certain track record before they're going to onboard it. And so those two categories we saw very strong flows. Real estate, not surprising, just given what we've been seeing in the marketplace with BREIT and with concerns around real estate, commercial real estate valuations. That category was in outflows last year. But what we're also seeing that's kind of forward looking for 2024 is we're seeing a lot of firms raise capital in the infrastructure sector. We're all suffering from inflation, and I think that the infrastructure story resonates right now. And so there are now 8 interval and tender funds, whereas a year ago there was only one. The other trend that we're going to see a lot of net flows, I think, is into secondaries focused funds. A lot of, given valuation concerns, there are some new products that have been launched recently. Apollo, for example, has a secondary focused product. There's several others that are still in the SEC registration process. So those are going to be very timely, and that was not a category that existed a year ago. There are a couple private equity funds that do include a small allegation to secondary private equity. So there's a lot of opportunities for people interested in secondaries.
Yeah, absolutely. That's great. What would you say? I mean, obviously you have mutual funds, you have ETFs, you have interval funds. What are the common misconceptions that people have with the financial advisors or investors have when investing in interval funds? What are the kind of the main questions you always come up against?
I think that what's most concerning for the industry is how interval funds are being sold, because there's a lot of complexity with the structure, with alternative investments as is. So people are inclined to kind of take shortcuts when they're talking about these funds, just because we're all busy, we're all time starved. So the worry that I have is because interval funds do share some characteristics of mutual funds, meaning if they're daily NAV, investors can get in on a daily basis, and it can be done electronically through the mutual fund ticketing platform. So if their experience on the way in is that it's like a mutual fund, my concern is they'll forget, or they'll think, 3 years from now, 5 years from now, when they go to sell the position, the expectation is that they're gonna be able to get out the same way, but the in and the outs are different, with an interval fund. And so we like it when some of the market leaders, like Variant has an interval fund that's been very successful. Another firm is called Bow River with their private equity fund. They are very thoughtful with advisors and investors on the front end, talking with them about their time horizon, talking with them about the reality that liquidity is going to be limited. And so that's the right way to do it. It's just a longer conversation. So I love that people are, having opportunities to get access to alternatives, but what we don't want is expectations to be off and people to be disappointed. So that's really important. The other issue I think in the industry that we're grappling with a little bit is, there's sort of a spectrum that's developed in terms of high quality and low quality, and I think that's just going to take time to shake out in terms of, a lot of the institutional alternative managers with long track records have waited to see if this is a viable product structure, because a lot of those GPs say, well, if I can't raise 2 billion in an evergreen structure like an interval fund, then I'm not willing to spend the time and go pursue the opportunity. But now we have proof. There are now 20 top 20 funds are all north of 2 billion. So with that evidence, that's why we're seeing new fund sponsors enter the market. But these products are neither easy nor are they cheap to launch. So that's another misconception. I have heard people say that they're fast and they're easy to launch. And it's like, well, yeah, if you launch it the wrong way, I suppose you could say that. But the right way to do it, the way that the current market leaders have done it, it takes time to be thoughtful. And so we coach a lot of GPs on how best to structure the fund from the get-go so that, advisors and investors have the best, experience investing in the fund.
Touched on a great point there because you mentioned the cost. So I was actually thinking about, could you kind of give us a rough? I understand there, a different vendor is going to charge a different price, but can you talk to us about maybe the cost to start an interval fund and the time that it would take to, get one up and running?
Sure. So organizational costs, let's just take a private credit fund, which has a little less hair on it than maybe private equity, but organizational costs, it'll cost you $500,000. A lot of the fund sponsors, and most of that is legal expense. And i- most fund sponsors are fronting the costs, the organizational costs. They're not having shareholders bear it. Um, some funds that scale very, very quickly, they might put that expense to shareholders, but that's about what it costs. Now, time, the evidence shows that it takes about 7 months to get through the SEC registration process, but that's just one part of the process. What we're seeing really is it takes about a year to get to market. We help clients sort of expedite their timetable. It shouldn't take 7 months to get through the SEC process. And actually, everybody likes to blame the SEC, but the SEC is not to blame here. What happens is that a product is sort of half baked and they'll file their legal documents with the SEC and then they'll make changes along the way. Well, that's not the best way to go about the process. So, but once again, these are complicated products, and as the fund sponsor and the organization talks to their middle and back office, you can understand why some of these changes do happen. And so the time is what's really, really precious, because what we find with our consulting clients is they'll spend probably a year on the front end evaluating whether or not they want to even pursue the opportunity, and they'll be looking at their competitor set, and then they make a decision to pursue it. So from there, then they've got a product build process that can take 9 to 12 months.
Yeah. And to your point, obviously distribution components, how they're going to go to market, right, are important and critical platforms and all that, right?
We always tell our clients that they have to start with distribution. It is the most important and frankly the most time intensive step, is to think through sales, marketing, national account considerations, because a lot of these GPs, they don't even have, most of them don't have a sales force. Maybe they have several people in investor relations, but this is a very different exercise if you're going into the wealth management channel, and you're going to need people who know how to cultivate relationships with financial advisors.
Absolutely. Those are great points. And obviously, you guys can kind of help, your team can help GPs along this way of the path of getting through the process and getting to market, which is great. That's definitely a crucial step, right? To your point.
We do. And, we actually found that a feasibility study on the front end, which is really something where you look at economics, you help a GP understand where's the break even, you help them understand a typical timetable, you also help them think through some of the operational issues, and frankly contemplate if there's any yellow flags or red flags that they need to address on the front end. So we do that for all of our clients, is take a hard look at, does this channel, does this product structure make sense for you? Because if you're a real estate manager, maybe a REIT, a REIT or a private REIT or a registered non-listed REIT makes more sense. So thinking through different product structures and different audiences for those products is what we help clients think through. And everybody calls us about interval funds, but often it's not the best structure for what they're trying to achieve, because if they want to maintain the institutional integrity of their strategy, they may have to create a different sort of product structure. And so we'll help them think through that. As an example of that, we've had managers who are just a better fit for a listed closed-end fund vehicle or a London listed vehicle, given what the audiences in those marketplaces prefer. London is really interesting because it's dominated by alternative investment strategies, but they typically have like a sustainability or an ESG bent to it. And as you know, in the US, those have been out of favor now for a couple of years. So we can give people advice in terms of which market they should, which opportunity set they should pursue.
Absolutely.
How do you foresee the landscape of interval funds evolving over the next, I don't know, 5 to 10 years? Uh, and any kind of thoughts on, the future of these types of funds?
We do, about a year ago, I asked my team to basically make projections based on historical trends, but also based on what we're seeing. So our research, we basically are projecting out 3 years in terms of number of funds and asset growth, and we're seeing growth rates in the mid-teens, so about 15%, and those are probably a little bit conservative. You've got McKinsey, who does a lot of research on the wealth management space, and they talk about the retail market for alternatives growing at a rate of about 20%. So you're going to see a lot of growth, and the interval fund market is just one product structure that's a good fit for alternatives, but you also have tremendous growth happening with non-listed REITs and non-listed BDCs, and there's also some specialty structures that have popped up which are a better fit for things like infrastructure, where the manager takes control of an asset. It's hard to take control equity positions in an interval fund structure. So there's a growing array of alternative products, and this category of funds is expected to grow at 15 to 20%. And that's, not surprising when you think about institutional capital pools shrinking over time, because none of us have defined benefit programs anymore. We're all saving in our 401ks. And so the industry also needs some innovation on that front, so that more retirees in target date plans, also in model driven portfolios, have access to interval funds. We're getting there. We're starting to see some firms work to solve that that problem for the industry.
That's great. Yeah. You mentioned, Kim, earlier about like your technology or some things that were done manually, maybe distributions or whatnot. What innovations are happening or you perceive that need to happen with technology and infrastructure to kind of build out a more spoke, a seamless model to get investors in the door, better distribution components and more flows in the market these days.
Yeah, I think the highest priority is to have systems built at the clearing and custody firms to make what is a manual process now more of an automated process to handle the quarterly liquidity, because it's such an important element of the shareholder experience. But you can understand, because the clearing and custody firms are having to charge quite a bit of money, because it's involving people's time as opposed to system or technology time. So that's really the critical issue. And I think that technology investment will come once the marketplace scales to a certain size. So it's hard to say, is it 300 funds? It's probably going to be pressure from some of the industry leaders in terms of creating, and once you have scale, you'll have the economies to be able to support some of the technology investment that's needed, because there's actually a couple of fund sponsors now that are pushing on this. Nuveen, my former firm, and Oaktree have actually filed with the SEC to get SEC relief to do a monthly repurchase. So instead of quarterly, which is what's typical in an interval fund, they've asked the SEC to consider allowing more frequent liquidity. So for certain strategies, if you think about maybe like a strategy that's fairly liquid, but it's using leverage or it's using derivatives. So it fits in the interval fund structure, not because it's like illiquid private equity or illiquid real estate. It's more of a, let's take a hedge fund style strategy. You could see that offering more liquidity more frequently would make sense for a strategy like that. So that would represent an expansion in the use case. But right now, having monthly repurchases in a system where it's a manual process, that I can imagine that's sort of a nightmare for these clearing and custody firms. So we'll see. Even if the SEC does allow that to go through, that's why some of this technology is needed, because I think the some of the fund sponsors are being innovative in terms of trying to improve the shareholder experience. But it's still pretty early days. We say it's second or third inning for the interval fund marketplace, because there's a lot of advisors and investors who still don't even know, like what is an interval fund, and the education is happening and it's moving pretty quickly, but there's still more to go.
Yeah, definitely. I'm assuming some of these funds are actually still going through the TransVision Direct via check and app in a lot of ways, still given the challenges with the platforms out there.
Yeah. So, like, we've seen that because of compliance concerns, even funds that don't have suitability restrictions, they'll be limited to accredited investors. And then they also will have to be subscription document, which that is really hard for clients and advisors. I'm not going to say it kills the sale, but it makes it a lot harder. We need advisors to have electronic ticketing for these types of products because, I mean, particularly for advisors who have discretion, we have to try to make, their lives easier because they're also time starved. They have a lot of priorities.
Right, 100%. Yeah, have tens of thousands of investors coming through. A manual process is not exactly feasible, right?
Right.
Skylar and I both come from the fund administration side, so we, we've seen how some subscription documents could be quite cumbersome at times.
Yeah. It made me think of there are a number of RAs or independent advisors because of what you're talking about. Some of these RAs have long used private markets and they've had their clients go into private funds. So that was fairly cumbersome because they'd have to have the client fill out subdocs for 12 different private funds. And so we now have a handful, I think there's 10 or 12 RAs who've set up proprietary interval funds. So that way, new clients, when they go into the fund, they if they have a subscription doc, it's one set of papers as opposed to 12. If it's electronic ticketed, they don't even have to fill out any of that. So we've had that conversation with a number of RAs. Some of them will sell it just to their walled garden, their own clients. Some will open it up broader to investors, beyond their client pool. But it is interesting how some of the innovation, making it easier for advisors and their clients, we've already seen that as an element of the interval fund market.
That's very interesting. Yeah, appreciate you highlighting those points there. Um, and I guess for folks you're talking to, maybe already have a private fund or they have a mutual fund. What's the conversation? Obviously, it's different audience you're going after here. When you have those conversations about what this product will solve for the marketplace, where they fit into the wheel, if you will.
If you look at the whole market, about 70% of the fund sponsors are alternative boutiques, meaning firms that have never had mutual funds or ETFs. So those firms are having to come up the learning curve on what does it mean to manage a 40 Act product? What does it mean to do, frequent shareholder reporting? And then the middle and back office have a lot to learn. Some of that can be outsourced to service providers, obviously, but that is the dominant part of the market is firms that are having to learn that from scratch. Now, about 20% of the market is traditional mutual fund firms, firms like Nuveen or a Franklin Templeton or a PIMCO, firms that have a wide mix of products. Those firms, have been coming on strong in this market because these products tend to be higher margin for them than mutual funds or ETFs. And as we continue to read in the paper that mutual funds are, they're dying a slow death. And so I think we're going to see, we see it all the time in terms of mutual fund firms like Diamond Hill. They're an example. They just filed for an interval fund yesterday, but they're largely a mutual fund sponsor. So I think we're going to continue to see that. I like actually having the mutual fund sponsors in the market because they're able to educate a much wider base of investors and advisors, and frankly, their marketing and their literature is hands down better. I think a lot of the GPs, they'll ask me, they're like, "Do I really need a website for the fund?" And it's like, well, if you want people to find the fund, yes, you need a website. So you have funny dialogue around some of that because all of that sales and marketing is new if you're a GP that's primarily served institutions.
Those are great insights there. Yeah, to your point, like, it's the same SEC process. It's a trust oversight and board that a mutual fund would go through, but it's obviously you're getting access to the private markets, which is a little bit different. There's nuances around that. You're a GP coming into the space from a hedge fund or private equity fund. Things are a little bit different in how you go about.
They are. And, we spend a lot of time helping our clients think about just even having a fund board is very different than having an advisory board or a corporate board. And I think initially, some of the GPs think that they need like very prestigious people, on their fund board. And it's like, well, I mean, you want people with experience and who are credible, but it's kind of a different board that you're putting together, because management needs to get along with the fund board, and there needs to be a level of trust there. But you're not looking for some sort of flashy, well-known celebrity to be on your board. You're really looking for, someone to serve on your audit committee, someone to serve in governance. So we actually have a database that we keep of fund board candidates, who we're seeing a lot of firms stand up, even if they have a mutual fund board, they're standing up new boards because alternatives, the realm of what the board has to focus on is a bit different because there's a lot of conversation around valuation, and so it's a different oversight role, and so there are a lot of new boards forming around that. So that's an element of advice too, because it's not something that they've had to manage, and that's an ongoing relationship with your board that's important, that you know that's functioning at a very high level.
Could you, on that note, could you talk to us a little bit about requirements for board and why or the kind of the value that a board adds and kind of what they do?
Typically, you need 3 independent trustees. That's always a conversation because I think people want to put a bunch of employees or, known friends, on the board. And really what you're looking for is a level of independence. You can have interested trustees, maybe 1 or 2 serve on the board as well. But when it comes to voting, for the record, it's just the independent trustees who are going to vote on things. And so you have to have someone who chairs the board, someone who chairs the audit committee, and who chairs the governance committee. And those typically are separate people. And so you're looking for people, who understand alternative investments, who have some familiarity with the asset class and comfort around the valuation for these types of securities. And then the other thing too, with your audit committee, you need someone who is, a financial expert, a CFO, or maybe a former auditor. Um, and I would say that if somebody is familiar with sales and distribution, it's particularly helpful, because these products, interval funds, are evergreen, they're continuously offered, and so the ongoing sale is really critical, to the health and wellness of the fund. So you need a board member who can give you input or thought on that. But they're really there representing the best interest of shareholders. They're not there. They're going to hear from management, but that's their job, is to represent shareholders. And so what's best practice is that you don't have a clubby board of people, that you friends and family type board. Your board is going to be in front of gatekeepers, and you want to make sure that you're sort of choosing wisely.
Yeah, absolutely. What are some common drivers of deciding to make that decision to move forward with a closed-end structure that makes sense for their firm, right? What are some kind of main drivers there that people think about as they come to you and say, "Hey, we have this idea, we have this strategy, we have a couple funds in house, maybe private fund or maybe a mutual fund. We're looking at a different audience." What are some main things that you kind of have a discussion about?
Yeah, I mean, I think a lot of people, there's definitely some knee jerk reactions where, the CEO is like, well, I've been hearing about interval
Yeah,
funds, so we need to go launch one of those. Or what happens sometimes is gatekeepers, when you're in pitching your private fund, even if you're already on platform, some of those gatekeepers are saying, hey, come back to us with this strategy in the interval fund format. So that's actually driving more conversions for, fund sponsors than you would think. I think there's a lot of firms, frankly, smaller firms maybe, that see this as sort of a bit of a land grab opportunity to be early to entry, and to be sort of a category type leader, And I think there's a little bit of that to the extent that you're able to scale a fund and sort of plant the flag. You don't necessarily need to be Blackstone, or Aries. So some of these managers have done very, very well. And so that's what's driving. There's motivations for established alternative managers, and there's a lot of motivations for smaller boutiques to try to come into the market. And then there's just simply profit, and margin considerations. Is everybody is thinking about, okay, well, if I manage institutional money, those capital pools are shrinking. If I manage mutual funds, you know, I've got a lot of price pressure. I've probably got to cannibalize my mutual funds with active ETFs. So there's a lot of industry driven factors also top of mind for both alternative boutiques and mutual fund sponsors that's contributing to the growth here.
That's great. I'm glad you brought that up because I think fees obviously are probably a big conversation or driver. I've been charging X in my private fund. Now I want to go into this space and what can I charge for a mutual fund? And we're getting, fee pressure to your point, or moving to the ETF side, given that fee pressure. How can we get to this market in a different product?
Economics are always what everybody cares about first. You have to clear that issue before people can talk about the other issues. There's a lot but if you have to understand the economics, you have to understand like upfront costs, what's the outlay going to be? You have to understand like what's the ongoing burn going to look like if I've got fee waivers on? And so therefore, what's the break even? And then after that, well, okay, a key driver of economics is how quickly is this thing going to grow and scale? We all want a $2 billion fund, which is very profitable, but how long does it take you to get there? So absolutely, economics is number one. And then the other kind of hot topic issues that we tackle quite a bit is the valuation, because there's a desire to get to daily NAV because that allows you to do electronic ticketing. So there are a lot of firms that are bending over backwards to try to get to daily NAV, even if their institutional private fund is quarterly NAV or monthly NAV. And so that's a very different process that you're going to have to follow on a daily basis. And that can cause a lot of concerns from the operational team. And you can't price a security two different ways at the same firm. So sometimes that's why third party valuation firms get called in. Those firms have gotten better in terms of their coverage, and they've also gotten better in terms of their pricing. Because it used to be very, very expensive to get a daily mark on some of these illiquid assets. But I think that part of the industry is rapidly addressing the need for it. Some firms won't go to a daily NAV, they'll just be happy with more of a monthly NAV. But as we talked about, the net asset value strike dictates when people come into the fund. And so that's an important thing. If you don't want people waiting around, if you've only got a monthly NAV or a quarterly NAV, it's going to enhance the sale to the extent you can get investors into your product more quickly.
Well, Kim, this has been awesome. You want to start talking to us a little bit about, the value that investors find in these funds and, why people invest?
Yes. I mean, this is really important, which is, why would I take the time to study this type of investment opportunity? And the goal is to have an array of products that offer additional total return or potentially higher yields than traditional stock and bond investments. Another advantage of alternative investments is when added to the investment portfolio, you can see not only return enhancement, but you can also see risk reduction. So it goes back to what we learned, in college about the benefit of diversified assets that are uncorrelated. And by tapping into private market strategies, there are so many different interesting uncorrelated investment types that you can really achieve the desired diversification that's just not possible if everything in the portfolio is liquid mutual fund or a liquid ETF. And so I love to see the portfolio outcomes change for clients and the risk reduction potential is huge if people are allocating to alternatives appropriately. So, depending on the asset class, people are using them for different reasons. It might be higher income, it might be, you know, if you're talking about private equity or venture capital, you're clearly talking about a higher return objective. So, being thoughtful about adding alternatives can help clients sort of achieve a different return profile for the overall portfolio. So that's why we think it's worth the time to learn a little bit about some of these interval fund structures and the many attractive fund sponsors that we see in the market today.
Awesome. Well, Kim, this has been so much fun. Thank you so much for your time here. Where can people go to connect with you and learn more about XA investments?
Great. We've got a knowledge bank with a lot of resources and white papers at xainvestments.com. Would love to hear from you. If you have any questions, you can track us down on the website and learn more about interval funds there.
Amazing. We'll make sure to include that in the show notes as well. We appreciate your time, Kim.
Yeah, thank you. This was fun. I appreciate it.
Absolutely.
Awesome. Thank you, Kim.